Okay. I hope you can see the screen. Okay. Okay. Can you see the screen?
Yes, I can see the screen.
Oh, okay. Very good. So, okay. Okay. So yesterday we started with revenue, IFRS 15, revenue from contract with customers. And the bottom line of the standard is we need to recognize revenue when the entity has actually performed their side of the obligation or of the agreement. Every sale transaction is an agreement between the buyer and the seller. And so sale occurs when the seller has, let me see, executed his part of the agreement. So if the seller is to deliver some product to the buyer, the seller can only recognize revenue after they have delivered the product to the customer. Okay, the seller cannot recognize revenue if they have not delivered the products or rendered the service to the customer. Okay, so that's the fundamental principle under IFRS 15. And the principle the standard also gives us 5 steps to recognize revenue. Okay, there are 5 steps we need to follow to recognize revenue. Okay, the first step is you identify a contract with a customer. Every sale transaction is between a buyer and a seller. Okay, so and every sale transaction is a contract. It can be express or implied. You know, I mean, there are sales transactions where there's a formal contract, like let's say purchase of land. There's a formal leasehold contract, contract to sell. You know, those are like, and those are formal contracts. And there are also transactions where it's more or less like informal, like you go to the market to buy some cooking ingredients, okay, from the market women. I mean, it's not. I mean, there are no contracts covering the transaction, but there's an implied agreement between the buyer and the seller. You agree to the price of whatever the woman is selling. Okay, and once you make payments, the woman will also give you the ingredients you are buying, okra, tomatoes, whatever it is you are buying. Okay, so every contract you need to identify the customer. Okay, and you also need to identify the contract. Okay, the contract, which is the agreement between the parties. Okay, so when you watch the videos, we go deeper into this step. This contract alone, there's so much to it. Yeah, but I'm just trying to give an overview of it. Then the next step is identify the performance obligation in the contract. So, like I said, we have two parties. Each party has rights and obligations. The seller is obliged to, once the buyer makes payment, the seller is obliged to deliver the product or service. The buyer is also obliged to make payment. Okay, so each person or each party has a role to play in the contract. So you need to identify the performance obligation, like what are the obligations of the buyer and the seller. Okay, and the third one is determine the transaction price. So every sale should have a price. Okay, you need to determine the price. And in determining the price, we have to look at other variable factors like discounts, rebates, refund, all those are also aspects of pricing. Okay, you can give a discount or maybe a premium or maybe a penalty, or rebates. All those are also aspects of pricing. Okay. Then the next step is allocate the transaction price to the performance obligation in the contract. Okay, so after determining the transaction price, okay, then we need to allocate the transaction price to the performance obligation. So let's say that the buyer has an obligation to deliver 10,000 bags of cement. Okay, so this is the obligation. Okay, and then we have, so we need to assign price to this 10,000 bags. What is the price of this, of the delivery of the 10,000 bags? Okay, that is what this step is talking about. We need to allocate the transaction price to the performance obligation. So maybe this 10,000 bags, I mean, will cost maybe I don't know, maybe 5,000 cedis. Okay, so we are trying to allocate the transaction price to the performance. So every performance obligation must be priced. Okay, every work in the contract must be priced. Okay, so the next step is recognize revenue when or as the entity satisfy performance obligation. So now uh, we have priced the performance obligation. Okay, that is 5,000 cedis, but we cannot recognize revenue until the the goods are delivered to the customer. Okay, so we have to wait until the goods are delivered to the customer before we can recognize revenue. Okay, so this is the summary of the 5-step model. All right, so when you watch the video, we go into detail under each of the steps. Okay, so today we are still continuing. All right, but today we are looking at cost to fulfill a contract. Cost to fulfill a contract. So there are some contracts that, uh, as the seller, or as the let me say, as the party who is going to execute the contract, there are some certain costs you may incur ahead of time. Like there are some costs that you will incur as part of uh, uh, was executing the contract. So let's say that you are a road contractor. You've been you've been contracted to build a road from maybe point A to B. Okay. Now you may have to use your own money for probably hiring some labor, getting some workmen and labor, and maybe getting buying some machines for the project, or going to hire some machines for the project. Okay, so you may incur certain costs, as part of uh, execution of the contract. So now, how do we handle the cost that you have incurred when you are executing the contract? Okay, that is what this aspect is looking at. Okay, so cost incurred to fulfill a contract might be within the scope of another standard. So the IFRS 15 says that some of the costs may be included in maybe dealt with by another standard, maybe by IAS 16 PPE. So assuming that what you are, I mean, the cost that you are incurring, okay, it's related to acquisition of a non-current asset, like it's a PPE item. Okay, then it means you have to treat that cost as PPE, IAS 16. Okay, if that cost is related to intangible assets, okay, you have to treat the cost as an intangible asset. If the cost is related to inventory, then you have to treat the cost as an inventory. Okay, so the standard acknowledges that the cost to fulfill a contract may be within a scope of another standard. In that case, we treat that cost based on that standard. Okay, that's what the standard is saying. But sometimes the cost you have incurred may not be related to any standard. Like it's totally not related to any standard at all. So in that case, how do we deal with it? That's what we need to look at. Okay, so it says there are some costs that may not be that may not be related, or that may not be under any of the existing standards. So in that case, those costs must be treated as an asset. They may be recognized as an asset, or they may be capitalized if the following criteria are met. Okay, so one, the costs relate directly to the contract. If the cost is related to the contract, is because of the contract, that is why you have incurred the cost, then we can capitalize it. Two, the cost generates or enhances the resources for satisfying the performance obligation. If the cost we are incurring will help us to perform the work, the contract, okay, if the cost is, we cannot avoid it, it is as part of the we need to incur that cost in order to perform the contract, then we have to also note it. Then the third point is the costs are expected to be recovered. So as part of the contract, there's no way you are going to incur costs that you will not recover. Then what is the point? By all means, all the costs you are incurring, at the end of the day, the other party will pay for it. So if you are contracted to build a road and you have used your money to maybe purchase some items, materials, and so on and so forth, that means you expect to recover the cost from from the government or whoever contracted you. Okay, so we expect the cost to be recovered. Okay, so the standard says that if you incur a cost to fulfill a contract, that cost should be recognized as an asset. Okay, it should be recognized. So examples of costs that relate to as contracts. Examples of costs that relate to contract are direct labor, and direct materials. So road construction, you need labor force. You need labor force. You need people, construction workers to work on the project. You need you need sand, we need cement, you need a whole lot, stones, granite, so on and so, bitumen, and so on and so forth. So all those are costs that relate to the contract. Okay, and then allocation of costs that relate directly to the contract or to the contract activities. So any costs that relate to the contract activities is also a contract cost. Then we have any cost that is chargeable to the customer. Okay, so maybe in the agreement, um, the contractor will charge the cost to the customer. Okay, so if the cost will be charged to the customer, it is also a contract cost. Okay, so let's look at amortization of cost to fulfill a contract. So when you capitalize that cost, the cost will not be there forever. will not be in the balance sheet forever. It must be capital. It must be amortized. Okay, it means that every year or periodically we must. It's just like depreciation. We must allocate a portion of it to the P&L. Okay, we must allocate a portion of it to P&L. So let's look at example here. Bright Future Academy signs a 1 year tuition contract with a parent on September 2025 for a total fee of 12,000. Before the academic year begins, the school incurs the following costs specifically for these students. Okay, teacher onboarding and preparation. So they have to look for a teacher to teach the child. That's 2,400. Customized learning materials, 1,200. Marketing and admission processing costs, 600. General and administrative salaries, 800 cedis. The school is confident that all eligible costs will be recovered through the tuition fee. Okay, so they know that all the costs they have incurred, they will get it back from the tuition fee. Required. Identify which costs qualify as costs to fulfill the contract under IFRS 15. Show how the costs are amortized over the year. Explain which cost must be expensed immediately and why. So we need to look at them one by one. So identify which costs qualify as costs to fulfill a contract and IFRS 15. So when we look at it, we need to critically look at the those costs that relate directly to the contract. So from the we can see number one is um, um, teacher onboarding and preparation. Is as you can see, it's a direct cost. Then okay, so teacher onboarding, then customized learning materials too. This is also a direct cost. Marketing and admission expenses. So these two, they are administrative expense. They don't relate to the contract. Okay. So the cost to fulfill the contracts are two. Okay. The first one is the teacher onboarding, and then the second one is the what is the name? The customized learning material. So this plus this is 3,600. So there's a cost to fulfill the contract. Okay. Number two, show how the costs are amortized over the year. So we are going to capitalize this 3,600, but we need to amortize it over the contract period, which is 1 year, which is 12 months. Okay, so we just have to divide it. We divide the cost to fulfill contract by 12. So we are going to amortize this amount by 3,300 per month. Okay, 300 per month. Okay, now let's look at impairment of cost to fulfill a contract. Impairment of cost to fulfill contract. Okay, impairment is when the carrying amount of an asset is more than the recoverable amount. Okay, so that's the principle. So if the current amount of an asset is more than recoverable amount, there's an impairment. So sometimes the current amount of the cost to fulfill the contract may be higher than the recoverable amount. Okay. So in that case, we will say that the cost to fulfill the contract is impaired. So let's look at an example here. A company capitalized 20,000 cedis as a cost to fulfill a service contract. So okay, this is what they capitalize. Okay, so that means that's the contract cost that they've incurred for the project, and they have to amortize it. So amortization to date, they have amortized 8,000. Okay, then remaining consideration expected from the customer. So they are expecting. So the customer has made some payments. This is what is left for the customer to pay. Okay, and the remaining cost to complete the contract. Okay, there's still some costs to incur to complete the contract. Okay, so we need to determine the impairment. Now, the according to the standard, the recoverable amount, okay, is the remaining amount, whatever we are expecting. Okay, is the remaining amount, okay, minus the remaining cost. Okay, so it's like you have undertaken the project. The I mean, the customer has made some payments. The customer is left to pay you 2,000 cedis. Okay, that's what is left for the customer to pay. But you also have some costs to incur on the project. Maybe you also have maybe 1,005. So which means that if the customer gives you the 2,000, you will take 1,005 out of it and use it for the work. So in other words, you only have 500 cedis. Okay, as your I mean, that's what you will get as your income, because this 2,000 cities, when it is given to you, you will take 1,500 out of it to buy some materials for the contracts, or you use it for other stuff connected to the contract. So, in other words, this is the recoverable amount. This 500 here is what we call recoverable. It means that this 2,000 you are going to get, you only at the end of the day, this is what you will get. Okay. Mhm. So to determine the impairment, okay, is the current amount minus the recoverable amount. Okay, impairment is when the current amount is more than the recoverable amount. So from our question, the recoverable amount is 10,000 minus 4,000. Okay, because we are expecting to 10,000 from the customer, and we have some 4,000 cost to incur. So it means we are our recoverable amount is 6,000. Okay, that's 6,000. Okay, then the current amount of this contract assets is 20,000 minus, is the cost minus the accumulated amortization, which is 20,000 minus 8,000 will give you 12,000. Okay, so the impairment here is what? 6,000. Okay, so this is how we calculate impairments under IFRS 15. Okay, so the current amount is this, then the recoverable amount is this, the impairment is this. Okay, now let's look at contract assets. Contract assets. Okay, what is contract assets? Okay. Now, contract asset is okay. So, contract asset. When we talk of contract asset, so sometimes in the contract we have the buyer here, is we have the seller or the supplier. We have the supplier. The supplier is has delivered the product to the customer. So this is a customer. Okay. The supplier has brought the product to the customer. Okay. But the customer has not paid. Okay. The customer has not paid. Okay. So in but even though the customer has not paid, okay, the agreement has not also been um, finalized. You know, maybe the agreement is ongoing. Okay, but we have not finalized the agreement. But the supplier has already supplied some materials or some of the products already to the customer. Okay, okay, the customer has received the goods. Okay, now how are we going to account? How will the supplier account for the goods that the customer has received? Meanwhile, the customer has not uh, paid, and also the agreement has not been finalized. Okay, so this is what we call contract assets. Okay, so contract asset refers to goods or services that has been delivered to the customer where the customer has not paid for the goods and also the agreement has not been finalized. Okay, yeah. But if the agreement is finalized, if we agree on the agreement, we agree on the terms of the agreement, then this will become a receivable. Okay, so it will be a receivable instead of a contract asset. So contract assets is just like a temporary account where goods are where we account for goods delivered to a customer where the customer has not paid for the goods and also we have not concluded on the agreement. It means probably the customer can return the goods because we have not, or maybe the quantity we have supplied is not up to the specifications. So those goods are called contract assets. Okay, but if we agree on the terms of the contract, then and if the customer has not paid, but we have supplied to the customer, then it becomes a receivable. It becomes a receivable. It's like it becomes account receivable or trade receivable. Okay, yeah. So it means trade receivable refers to goods we have supplied to a customer. The customer has not paid, and the contract is crystal clear. We have finalized it. There's no doubt about it. So we are certain that we are going to receive from the customer. Okay, so that's
I can't hear you.
oh, sorry. Oh, sorry about that. Uh, yeah. So
You have muted yourself when your child started crying.
yeah, it's true. Yes. Oh yes, yes. So yeah, I was talking about contract assets. Okay. Now you can hear me now, right?
Yes.
Okay. Yeah, I was talking about contract assets. So contract asset is when a customer supplier delivers goods, okay, deliver goods to a seller, a buyer. So there's a supplier. So the goods are here. But the buyer has not paid. The buyer has not paid for the goods. And also the contract has not been finalized. Okay, not finalized. Okay. So in that case, because the contract is not finalized, we cannot say this is a receivable. We cannot say it's a receivable. Okay, because the contract is not finalized. The customer can return the goods back to the supplier. Okay. So in such a situation, this becomes a contract asset. So contract asset refers to goods that are supplied, goods or services that we have delivered to the customer, where the customer has not paid, and also the contract has not been finalized. Okay. So if the contract or once the contract is finalized, then we move it to or it becomes a trade receivable or becomes an account receivable. Yeah. So that is what it means. So it means from contract asset to what? It's just a reclassification in case the contract is finalized. Then we reclassify it from contract asset to account or trade receivable. You know, so that is that is what it is. Okay, so we have looked at contract assets. Let's look at contract liabilities. That's the opposite of contract assets. Here, the buyer is the one who has paid, the buyer has paid the supplier. Okay, this is the supplier. He has received the goods, but he has not delivered the goods. He has not delivered the goods, but he is holding the customer's money. So it becomes what contract liabilities. Okay, but the agreement has not been finalized too. Okay, so if the what's the name? If the supplier, okay, delivers the product or service, then the contract liability becomes revenue. Do you get it? Once, so it's the double entry is like this: debit, credit. So contract liability has a credit balance. Contract liability. So maybe 3,000. Okay, we have not delivered the product, but we have received the money. So if we deliver the product, then we will debit the contract liability and credit revenue. Okay, so to move from contract liability to revenue. Okay, so that's contract liability. Okay, so let's continue. Okay, now let's look at sale with a right to return. Okay, so this is, I mean, in some commercial transactions. Okay, you can sell goods to a customer, and the customer can return. Per the agreement, the customer can return the goods for within a period of time or within the first 1 month, 2 months, you know. So in that case, it's called sale with a right to return. Okay. So you can return the goods for a refund. You return the goods and we give you back your money. Or we can give you a credit, or we can give you a replacement. We can give you a new product to replace the one you brought. Okay. So a sale with a right to return occurs when a customer is allowed to return goods after purchase and receive a refund, a credit, or a replacement. Okay, so now as usual, how do we handle or how do we account for a sale with a right to return? Okay, so this is how we are going to account for sale with a right to return. Okay, first we have to since we have sold the goods, we have to account for treat it as revenue because we have delivered the goods to the customer. Okay, but when we are recognizing the revenue, we have to be careful, especially if we know that whatever we are selling, the customer is likely to return a portion of it. So let's say that we have sold 300 bags and we know that it is likely the customer will return maybe 50 bags. We know the customer will return 50, it's likely. So we recognize revenue for 250 because that's what we are certain that we'll earn. But with this one we are not sure. So even though we have delivered 50, we know that we have delivered 300, we know that 50 may be returned back. Okay, so we recognize revenue for the portion of the revenue that we expect to be entitled, like we think we'll earn it. Okay, so that's the key word here. Then we also have to account for a refund liability. A refund liability means we should be ready to pay for whatever the customer will return. Okay, because as we are selling, we are expecting the customer to return some of the products. So we should prepare for it's like a provision. We should make provision for whatever um the customer is going to return. Okay, that's one. Then we should also recognize an asset for whatever the customer will bring back to us. You know, if the customer brings the goods back to us, it becomes like inventory for us. Okay, if the customer bring those goods back, maybe it's damaged or whatever it is. If the customer brings it back, we will receive it into our store. So it becomes like an asset to us. So it's like a receivable to us. Okay, yeah, it's a receivable. So when we recognize revenue, recognize refund liability, and also recognize a receivable, which is the portion of the revenue of the sales we think the customer will return. Okay, we have to treat it as an asset. So let's look at an example. A shop sells 50 items at 100 cedis each. Okay, this a shop sells 50 items. The cost of each item is 60 cedis. Okay, based on past experience, the shop expects 5 items to be returned. So even though they are selling 50, they expect that 5 of them will be returned. Okay. Required. Show the journal entry at the time of sale. So we have to recognize revenue for the portion that will not be returned. We have to recognize refund liability for whatever we have to pay to the customer. And also we have to recognize an asset for the portion of these five items that we expect to receive from the customer. Okay. So let's look at um, how the solution is. So we have expected returns. So we are expecting five goods to be returned. Okay. And what is the value? Okay. Each each product is 100 cedis, isn't it? It's 100 cedis. So we are expecting 500 to be returned. Cedis. Okay. Value to be. So the revenue we are going to recognize is the 5,000 minus 500, which is the 4,500. We are selling 50 items. So 50 times 100 is 5,000. Then we are returning five, or we expect customer to return five, which is 500. So we have to recognize revenue of 4,500. Okay. So we are going to recognize revenue of 4,500. Then we have to recognize cash, assuming the customer is paying. As for the customer, they will pay the full 50 items. So assuming they've paid the full item, it means we have to debit cash of 5,000. Or if they have not paid, then it becomes a receivable. Okay, so it's either a cash or receivable. Then we have a refund liability, which is the 500. Okay, this one is what we may refund to the customer in case they bring the goods. They bring the five goods. We have to give this one back to them. Okay. So this is the revenue aspects. This is the revenue and the liability aspect. Now let's account for the goods itself, the goods that are coming in. Okay. So when you sell an item, it affects your inventory and cost of sale. When you sell an item, you credit your inventory, like it is taken out of the inventory. So you will credit your inventory, you debit your cost of sale. Okay, so inventory, because the item is going out, then you debit your cost of sale. Okay, so we sold 5,000. We sold 50 items at a cost of to the cost is 60 cedis per item. So it means the inventory cost, the cost of the items in the inventory is 50 times 60. Okay, this time that's 3,000. Okay, so this is what has left where left the warehouse. Okay, so it means that we are going to debit inventory of 3,000. Okay, hey, we are not going to, we are crediting inventory because we are actually taking it out of inventory. So we are actually going to debit inventory. Hey, we are actually going to credit inventory. Inventory is 3,000. Okay. Okay, so we are crediting inventory of 3,000. Then we have to debit cost of sale. Okay, the cost of sale refers to the items we have sold. the cost of the items we have sold. Okay, so in fact we have sold 50 items. That's what we sold. But these 50 items, five of them may be returned. So we have to treat this one specially. Okay. So we are, and then 45 will not be returned. Okay, the 45 will not be returned. So it means that our cost of sale is the 45. Because this one we think it may come back, I mean it may be returned. So our cost of sale is 45 items. Okay, multiplied by the cost per unit. Okay, so 45 multiplied by 60 will give us 2,700. Okay, and then the five items that may be returned to us. Okay, that will be 5 times 60. Okay, 5 times 60 is 300. Okay, that will be a right. That will be an asset. Okay, but it is called right to recover goods. Okay, right to recover the goods. So that will be 300. Okay, so that's how we go about um sale or return. Okay, that's how we go about sale or return. Yeah. So I think that's it for IFRS 15. Okay, so we are done with IFRS 15. So let's look at the next standard. Well, which one should we do? Okay, we have done income tax, earnings per share, financial instrument. Okay, so let's do IFRS 9. So just a moment. Let me check something here. So, okay, so we let's look at IFRS 9 financial instruments. Okay, so this standard looks at the definition of financial instruments and the classification of financial instruments and the measurement of financial instruments and what else? Measurement, initial recognition, subsequent recognition, and all that. So we need to first understand what financial instruments are. Okay. Okay, now financial instrument, what is it? I'm sure we've come across it on several occasions. Okay, so a financial instrument is an instrument, okay, used in is an instrument used in business transaction or used in the world of commerce, okay, to either to raise funds. Okay, it's rather to raise funds, okay, or to either to raise funds or to make an investment in. Okay, so you can invest in a financial instrument, or you can use the instrument to raise funds. Okay, so that's what financial instruments are. Okay, and it's also a contract. Okay, every financial instrument has two parties. Okay, it's a contract between two parties. Okay, one person is the one who is issuing the financial instrument. The other party is the one who is receiving the financial instrument. Okay, and one person records the instrument as an asset. Another person records it as a liability. Okay, so when we say financial instruments, okay, they are okay. Financial instruments are contracts, or is any contract that gives rise to a financial asset of one entity and a financial liability or equity instruments of another entity. Okay, so like I said, it's an arrangement to raise funds or to raise capital. Okay, example is a loan or a corporate bond. That, or yeah, or equity instruments like shares. Okay, these are examples of financial instruments. Okay, and it's always between two parties. One person will record an asset, a financial asset. One person will record a financial liability or equity. Okay. So what is a financial asset? Okay, a financial asset is any asset that is cash. So cash is the financial asset. The money we have in hand is a financial asset or an equity instrument of another entity. If you have shares in MTN, what's the name? Farm Milk, EcoBank, and so on and so forth. That is a financial asset. Okay. Or a financial asset can also be a right to receive cash or another financial asset from another entity. Okay. So a financial asset can also be a right to receive some form of cash or other financial instrument from another entity. Example is when you sell goods on credit to a customer. Okay, you have the right to receive. You have the right to receive from the customer. So that becomes a financial instrument. So account trade receivable is a financial asset. Okay, because it gives you the right to receive cash from the customer or another financial instrument from the customer. Okay, so financial liability is the opposite of financial asset. So with financial asset, you are expecting to receive. It is coming to you. But a liability, that is the other way around. The one who is paying or who is delivering that financial instrument to the other party. Okay, that person is having a financial liability. Okay. So a financial liability is any liability that is a contractual obligation to deliver cash. So here the key word here is deliver. It's an outflow. Financial asset is an inflow, it's coming in. Financial liability is an outflow. It is an outflow. Okay, so examples of financial liabilities are loan payable. If you have a bank loan, you need to pay. It's a financial liability, or trade payable, or bonds or notes payable. Okay. Now let's look at an important aspect of under financial instrument. That's classification of financial assets. Classification. That's a very important area. Now, financial assets are classified into three categories. Three categories. Okay. So, um, what are these categories? And before we recognize these assets under category A, category B, or category B or C, okay, there must be reasons why we are classifying them into A, B, C. Okay, so what are the reasons why these assets are classified? Why don't we keep them as one? Why do we keep them, classify them into? So there are two main characteristics of financial assets. Okay, there are two main characteristics, or there are two main reasons for acquiring financial assets. Okay, the first reason is that you can you can decide to acquire a financial asset just to earn some interest on it. Okay, like maybe you purchase a government bond. So every year you receive some interest on the bond. Okay, so that is your what we say, that's your objective. The objective of holding the financial asset is that you want to acquire the financial asset with the intention of holding it and collecting contractual cash flow. Okay. And then also, you can also acquire financial assets with the intention of collecting contractual cash flow and also selling it. So if you buy shares Okay, you expect to receive dividends from the shares. Okay, at the end of the year, the the company may declare dividends, and then but you may also want to sell the shares when you think the share prices are rising. So here it's not like you want to keep the shares just to earn the dividend, but you are also, apart from the dividend that you are interested in, you also want to sell the main instruments if the price is high. So you see, so one is the two characteristics or the two reasons why we acquire financial assets. One, the first one, we are just keeping it to be earning some small interest. We don't want to sell the main assets. So it's like a tree. Okay, so the first one, we have the tree here. The tree bears fruit. So we have the fruit. We are only interested in the fruit. The tree is there. We don't want to sell the tree. Okay, so that's the first reason. The second one, the tree is there. I mean, we are interested in the fruits. The fruits, we like the fruits. But if, I mean, someone comes and is trying and has a good price for the tree, we can decide to sell the tree also as well, and maybe go and buy another tree, or go and start another plantation. So these are the reasons why we keep financial assets. And there are two main types of benefits from financial assets. One is, or there are two main types of cash flows from financial assets. Okay, so when you invest in a bond, maybe you purchase a government bond. Okay, so you earn interest on it. So you have the principal, you have the interest. Okay, you earn the interest on it, but you also get your principal back. So the cash flow you'll be getting is interest plus principal. Okay, interest plus what? Principal. So there are two types of cash flows from financial assets. These are interest payments and principal payments. Okay, now let's look at financial assets, the classifications. So financial assets are classified into three types. Okay, they are into three types. Okay, so where are they? Okay, so we have financial assets at amortized cost. Okay, amortized cost. Then we have financial assets at fair value through other comprehensive income. The financial assets at fair value through profit and loss. So when you acquire a financial asset, you have to decide how you are going to classify it. Either it will be at amortized cost, or financial asset at fair value through profit or loss, or through other comprehensive income, or through profit and loss. So we need to know which category you are going to classify your financial assets. Okay, but we need to learn each one, know the various categories. Okay, which financial asset falls under amortized cost, which financial assets fall under other comprehensive income, and all that. So let's start with financial assets at amortized cost. Okay, so these are financial assets acquired with the intention of holding it and collecting contractual cash flow, and where the cash flow is made up of interest and principal. Okay, so financial assets at amortized cost. Okay, So always we are looking at the intention for holding. Okay, the intention will tell you where to classify that financial asset. So amortized costs, they are financial asset that we are we are holding. We are not going to sell it. Okay, but we are going to be receiving interest and the principal components. Okay, yeah. So okay, so when we say amortized cost, okay, financial assets at amortized cost. What are we when we say amortized cost, amortization? Anytime we hear of amortization, it's like we are breaking something into parts. Okay, we are breaking something into parts over a period. Okay, so financial assets at amortized cost means that financial assets we are actually breaking the benefit and the interest over a period of time. Okay, we are breaking the benefit, so the benefit in the form of interest and the principal repayment. Okay, over a period of time. So over the period of time, how much principal are we earning? How much interest are we earning? Okay, and anytime we are giving the principal. Okay, it's going to reduce our balance. Okay, so maybe you have invested 3,000. The first year they have paid. I mean, the whoever bought the financial assets pays you maybe 1,000 every year. So it means every year when they pay 1,000 principal every year when the principal is paid, your balance will reduce. Okay, so amortization is like we are trying to um, account for the periodic benefits or cash flow that we are trying to derive from um, the what's the name from the financial assets. So let's look at examples of financial assets at amortized cost. Okay, loans and receivables. Okay, loans and receivables are typical examples of financial assets. Like when a bank and a financial institution gives a loan to a customer. Okay, the customer will pay interest and the principal, okay, over the period. So anytime the customer makes payments, okay, their principal balance will reduce, okay, and their interest balance will also reduce. Okay, okay. So one characteristics of financial assets at amortized cost is they are not held for trading. Okay, we don't trade financial assets at amortized cost. Okay, we just hold it to be earning the periodic principal and interest, but we don't trade. That is, we don't sell it to other parties. Okay, so what that's one characteristics of um, financial assets at amortized cost. Okay, let's look at an example. ABC has issued a loan of $100,000 to a customer at an interest rate of 5% per annum. The loan is to be repaid in 5 years with annual payments of 23,000. Okay, and it includes principal and interest. How should the loan be measured under IFRS 9, and what accounting treatment applies? Okay, so first we need to know how or what category this loan falls under, before we can even know what to do. So the loan is issued by ABC Bank, should be classified as financial asset, okay, and it should be measured at amortized cost. Okay, so let's look at the reason why we are classifying it for under amortized cost. So one, how to collect contractual cash flows. So, so ABC Bank business model is to hold the loan to collect the principal and the interest over time and not to sell it. So you see, is the intention. They are not going to sell the loan to somebody. They are just going to receive the principal and interest on the loan. Then you have to check the SPPI test. Okay, when you see SPPI, it's referred to. It's an abbreviation for solely payment of principal and interest. Solely, which is S, payments of principal and interest. What this means is that any cash flow out of the financial asset is interest and principal like this. Okay, for per the question, we are told that every year the annual payment is 23,097, and it is interest and principal combined. Okay, so the SPPI test is met. Okay, so we are the contractual cash flow is made up of solely payment of principal and what and then in principal and interest. Okay, so this is the amortization table. Okay, so it's for 5 years. So we have to prepare an amortization table. Okay, so at the end of the 5 years, the balance will be zero. Okay, because at the end of 5 years, we would have received all the principal and all the interest. So there will not be any balance left. There will not be any balance left for us. So the initial recognition is we recognize the the instrument at fair value, okay, which is the principal. I mean the loan amount, okay, which is 100,000 here. Okay, so we calculate the interest. In the interest is 5% of the what's the name of the loan amount. Then the payments, as for the payments, it's constant every year. Every year they are supposed to pay this. Okay, and then the closing balance. Then this closing balance will become the new opening balance for year two. Then we apply the interest on it, then the payments and the closing balance. And this balance will become the opening balance for year three. We apply the interest on it, the payments and the closing balance. Okay, and this one will come here, and this one will come. So at the end of the year, or at the end of the period, or the end of the period, our balance will be zero. Okay, so this is what we call the amortization of loan. Okay, so it means the bank is going to recognize interest income of 5,000. Okay, going to recognize interest income of 5,000, and also the loan closing balance as 81,000. Okay, so these are the closing balances of the loan. Okay, at the end of each year. Okay, Okay, so the amortization, this is the explanation. So it's 100,000 plus 5,000 minus the payments. Okay, this is what we left. Okay, so that's financial assets at amortized cost. Financial assets at amortized cost. Okay, now let's look at financial assets measured at fair value through other comprehensive income. Okay, first of all, we need to understand what other comprehensive income. Okay, can you help us with other meaning of other comprehensive income? I mean, what do you have any idea what it is? Hello.